if the stock market goes into a free fall, will you know your freak out factor? MarketWatch says that's the point when you lose so much that you start to panic sell and get out of the market. There's even a profile for the panic seller, usually above the age of 45, married, self-employed, and men tend to freak out before women. So how do you help your clients figure out their freak out factor, Brian? And hopefully they'll never get there.
That's a pretty good description of the freak out factor. That age and that description is interesting.
You concur?
Yeah. So I think, with all the tools we have today, we're trying to help people avoid the freak out factor, with regards to, just losing their assets, you know what I mean, from what they initially start with. So it's about finding that risk number, as we call it, like a scale of 1 to 10, 1 being I'm ultra conservative, I want to put in CDs or something very safe, fixed, and then there's 10, which is the Bitcoin or maybe a very aggressive individual stock that you own. I mean, 10 is, it's pretty risky. You could lose all your value. You could lose 90% in a month. I mean, that's a lot of money to lose. So it's finding that and narrowing that in for the right person. So people have expectations, right, going forward. It's like, look, you can lose 20% from your high on this whole, and it's not just an account, it's the whole package, right? Because we have investments, and a lot of people will say, well, this one, a Roth IRA, didn't do very well. I'm like, yeah, but you also have another $1 million elsewhere, right? So let's not focus on the 100,000 here.
Yeah.
I mean, we're looking at...
You lost 4% here, but you gained 7 over here.
Yeah, and so that's the thing. I don't want to talk about that. No, we're going to talk about the whole thing, or we're not going to talk at all. Yeah. I mean, that's literally the conversation, because to ignore one piece or throw everything out is not really looking at the whole package. And that's what investing is about, right? It's like, okay, what this Roth, if that's the most aggressive account, it has more volatility and can lose value in certain situations, depending on what it's invested in, right? I mean, sometimes Bitcoin's going down and the stock market's going up. That's called a non-correlated investment, right? It doesn't flow together with the S&P 500 or the Dow Jones. So you have those kind of weird opportunities, but your Roth, which you've heard me probably say, 10 times in the last 3 months, is the last thing that you're going to take for income. If you have $1 million, like this example we're talking about, you're not taking the Roth anytime soon. If you're listening to a good financial planner.
Well, that's a long time play, right?
Yeah, you got 15, 20 years probably in most situations that you're ever going to need it. So can you be a little more aggressive? You don't need something for 15 or 20 years, right? It's like a real estate investment. I mean, if you bought a piece of property, are you really concerned about the real estate market? And there's a lot of people that are saying this too, by the way, right now. Hey, I think the real estate's up in a bubble. It's going to burst. So some people may be afraid.
Of course, it's been at that point for like 2 years now. They've been saying it for a while.
Well, there's more. There's the economists I listen to that are looking at real data are starting to say that.
Oh, okay.
But they're not the people that are buying long term. It's not a concern. Now the flippers, yes. If you're planning on flipping that thing in 3 to 6 months and making
flip it quick, sell it quick.
Right. You do have a problem. You may have a problem, right? Because think how long it takes. I mean, we bought a piece of property to the office. It took 90 days to close, and then you start doing all this stuff to fix it up, and it might be 6 months. Well, the market can change in 6 months in real estate.
Oh yeah.
Right. And so, but if you're holding the property as an investment property for 20 years, what does it matter if it's at the high?
Yeah.
Because it's like looking at a chart.
You're going to weather storms here and there.
Yeah, you're going to have a bump in the road. It could go down 10% in value, 20%. I mean, we had a piece of property in Arizona went down 40% in a year and a half. It's crazy. But it also had gone up 70% a few years before. So, it's all relative. But the idea is that you've got to zero in on what you're trying to accomplish with each bucket of money, right? So if that first bucket of money is, I need this in 2 to 3 years, well, you probably shouldn't be in Bitcoin, right? You probably shouldn't be talking about cryptocurrencies and gold and silver and aggressive tech stocks that's the plan. If you need money soon, okay, so no, I need to buy some boring old exchange-traded funds, Vanguard funds, something that's going to be diversified over thousands of companies, something that you can maybe get some yield on. You get a decent rate of return, but you're not going to take the hits when the market drops. I mean, a lot of people will go, Brian, oh my gosh, the market's tanking, right? And I'm like, yeah, but your account is, pretty conservative. it's down 3% and the market's down 15, right? So
you're doing all right.
yeah, because we knew that you needed that money. That's your now money. That's your, soon money. You're going to be using that in the next 1 to 5 years. So then, well, what about this money? That one's lost more. Yeah, but that's your Roth. Again, you're not going to, I don't think you'll ever need it. I've said that to people. Well, how do you know? I'm like, well, because I could look at your financial situation. You got the pension, the income,
Social Security,
Social Security, real estate, everything that's flowing into you. I think you're passing this on to the kids unless inflation happens through the roof and, we're using our dollars to, use it for wallpaper. I don't know. Maybe you'll need it, but I don't see that happening. So let's not worry about the volatility in that account.